Hello and welcome to the Weekly Forex Outlook at xm.com. Next week, we'll get CPI inflation data out of the US, UK, Canada, and Japan, while investors will also be keeping their eyes on tariff-related headlines. In addition, China will be in the spotlight as trade data and GDP figures for the second quarter will be released. I'm Maria Pachardez, and joining me to discuss all this is senior market analyst Haralambos Bisuros. So Haralambos, can you tell us how the dollar has been doing recently? How has it been responding to tariff-related concerns? And how might the upcoming US CPI data impact the Fed's next moves and the dollar going forward?
Hello, Maria. The dollar held very well against its major peers this week, following renewed tariff-related anxiety. Although the 90-day delay, which was supposed to expire on Wednesday, was extended until the 1st of August, Trump said this week that he would impose a 25% tariff on goods from Japan and South Korea, while he threatened Brazil with a 50% duty, and other partners with lower rates. This allowed the US dollar to stay strong due to safe haven inflows. Now, in my opinion, this marks a shift in how the dollar responds to tariff-related anxiety. Back in April, it was hurt due to fears about the recession, but now it is benefiting as a safe haven, while upside risks to inflation are also helping it. Now, a few weeks ago, investors were expecting 65 basis points worth of rate cuts by the Fed this year, while the probability for a July reduction rose as a couple of policymakers expressed clear support for such a move. And Fed Chair Powell did not rule it out when he testified before Congress. Nonetheless, following the better-than-expected jobs data for June and Trump's fresh tariff threats, the July rate cut probability dropped to 5% from around 25%. Now, as for the CPIs, according to the ISM PMIs, prices in the manufacturing sector accelerated somewhat, but the non-manufacturing prices sub-index slid notably. Given that the manufacturing sector accounts for only 10% of the US GDP, this tilts the risks of the CPIs to the downside. So a slowdown in inflation may allow some market participants to reopen the door to the possibility of a July rate cut, which in turn could end the latest recovery in the US dollar.
Moving to the UK now, CPI numbers for June will come out on Wednesday. The Bank of England held interest rates unchanged at its last meeting. What are we expecting from the upcoming inflation data, and do you think it will change the BOE's rate cut bets in August?
Yes, the Bank of England held interest rates unchanged the last time and noted that GDP growth remained weak and that the labour market has continued to loosen. This led investors to add to their rate cut bets, now assigning a nearly 77% chance of a 25 basis points reduction at the upcoming meeting in August. Another quarter point reduction is fully priced in by the end of the year. Now, the Bank of England expects inflation to continue accelerating to 3.7% year on year this year due to higher energy prices and some regulatory price increases. So even if the data reveals some acceleration, I think that rate cut bets are unlikely to vanish. Perhaps traders will decide to take off the table a few basis points, but not something dramatic. Now, on the other hand, a notable slowdown could give another green light to policymakers to lower interest rates in August, and thereby this could weigh on the British pound.
Other inflation data will be released next week from Canada on Tuesday and from Japan on Thursday. What should traders watch out for?
The Bank of Canada is expected to deliver one more quarter point rate reduction this year, and with headline inflation already dropping to 1.7% in June, a very strong acceleration may be needed for that rate cut to be pushed into 2026. Now, as for Japan, sticky inflation may allow yen traders to start reconsidering the likelihood of a Bank of Japan rate hike before the turn of the year instead of the first quarter of 2026.
And finally, China's trade data will be out on Monday, and GDP for Q2 will be released on Tuesday. Now, given the ongoing trade uncertainty, what are we expecting, and how might this data impact the Aussie and the Kiwi?
The latest inflation data from China revealed that producer prices fell at a faster pace in June than in May, with deflation deepening to its worst level in almost 2 years. Now, although consumer prices accelerated for the first time in 5 months, the improvement was marginal, with the broader picture increasing pressure on Chinese policymakers to introduce more stimulus. So, although China agreed with the US to continue negotiating with the aim to find common ground on trade, the uncertainty over the global landscape is affecting local demand, and I believe that should next week's data corroborate the notion that the Chinese economy is struggling, the People's Bank of China may need to cut interest rates further later this year. If such expectations materialize, I believe that they could weigh on the Aussie and Kiwi, as China is the main trading partner of both Australia and New Zealand.
All right, Lomos, thanks so much. This was the Weekly Forex Outlook here at XM.com.